Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
Great. How are you doing, Ross?
Yeah, I'm doing very well. Thanks for asking. And we're very lucky to have you today because we're recording on a Thursday, one day removed from the Fed's first 0.5% rate hike in over 2 decades. Everything did seem largely in line with expectations, but obviously still a lot of ramifications for inflation and the economy to parse from this. So I want to turn it over to you. What's your big takeaway from this meeting?
Yeah, well, specifically, the Fed really did not deliver the hammer, so to speak, as many investors were fearing. And so you got a pretty good sized relief rally across both the fixed income markets and the equity markets. And by bring the hammer, I mean, there were a lot of whispers that the Fed was going to bring a 75 basis point rate hike and a much larger balance sheet reduction plan than they delivered, and could potentially also communicate additional 75 basis point rate hikes further down the line in 2022. So not only did the Fed not deliver a 75 basis point rate hike, they delivered 50, but they pretty much took the 75 for future hikes off the table for now. And they also, on the balance sheet, came in a little bit on the low side of the pace at which markets had been suspecting. We've often been saying that 50 billion is pretty much the minimum they need to go, that is reduce the balance sheet per month to really have any sort of substantial impact on net float in the Treasury and mortgage market, that is liquidity drain. And they came in at 47.5 billion. Yes, they will ramp that up to about 95 billion within 3 to 4 months. But the point is, they came in on the low side, and they came in on the low side both with everything, with balance sheet reduction, with rate hikes, and with forward guidance as well. And so no surprise, you got a bit of a relief rally in both equities and bonds. Today, you're seeing some of that relief rally give up their gains. So also not a surprise to see that.
Yeah, and it's funny to describe a meeting like yesterday where they're clearly very hawkish as dovish, but that did seem to kind of be the big takeaway. So with that in mind, I'm curious, what odds do you assign the Fed of actually succeeding in their goal of engineering a soft landing in the economy? That is, snuffing out inflation without inducing a recession. Do you think the odds of that are particularly high or maybe not so much?
About as close to zero as you can be without being zero. So that's pretty much the odds I would assign to the Fed sticking the landing, because the Fed, for the most part, really has never stuck the landing when it comes to price stability and avoiding a recession. Certainly not when inflation is as high as it is today, and they're so far behind the curve. With that said, they can probably bring this US economy into a very shallow recession slash growth recession, which is, for the most part, kind of would, in my opinion, would be a success. And that's kind of, I think, the best we can hope for. And that's probably sometime mid 2023 that we're looking at, a growth recession slash shallow recession. But I don't think they can stick the landing on this.
Gotcha. And so what does all that mean for rates? We'll use maybe the 10-year Treasury as a proxy. Where do you see the Treasury yields heading, and what does that reflect about the economy given the path that they've laid out and that you're talking about today?
Yeah, we'll give two scenarios, both of which would fall into the category of not sticking the landing. One is they over tighten, one is they over tighten. If they over tighten, that is, they raise the Fed funds rate to a level that is sufficient to bring inflation down, we'll say down below 3%. I wouldn't say down to their target of 2%. That's going to be really tough. But let's say they want to bring inflation down below 3%, and they have to over tighten to do that. That probably means that they're bringing the Fed funds rate up close to 4%. And in that environment, 10-year yields probably peak around 325, 350, but then begin to come right back down and dip below 3% along the way. And you tend to see the curve invert sometime around, we'll say, third quarter, fourth quarter of this year. That's probably the most likely scenario right now, given how high inflation is and given how strong wage growth has been. The other scenario is they under tighten. And that is, instead of bringing the Fed funds rate up to say 4%, they terminate it at maybe 2.25 to 2.5 to avoid a recession. And they avoid a recession, but inflation never comes below where wage growth is, which would otherwise be about 5%. And that means you get sticky inflation somewhere between 4.5 to 5.5%. And that means 10-year yields continue to make a move higher, most likely towards 4%. So in either scenario, I would call it not sticking the landing. But in both of those scenarios, I should say, in each scenario, you get a different outcome in 10-year yields. If they over tighten, 10-year yields come back below 3% and probably hold well below 3% until the Fed begins to ease again. And if they under tighten, then 10-year yields make a move towards 4% and quite possibly even above 4%.
Well, Tom, that's really great insight. I very much appreciate your time today, and hopefully we'll be able to talk again soon as things evolve, because your insight is always really appreciated on these matters. So thanks so much, and talk soon.
Yeah, my pleasure. Thank you for having me.